Welcome to my video on equity versus debt. In this video, I will be discussing the two main types of capital structure in business finance, namely equity and debt. Equity capital. Equity capital refers to the ownership stake in a company, represented by shares or stocks. Unlike debt, equity does not have a fixed repayment schedule or rate of interest. Instead, it offers an ownership stake in the company, entitling investors to dividends and voting rights. Equity represents the residual interest in the assets of the company, after all liabilities are deducted. It is considered a more risky form of capital as shareholders bear the brunt of any losses incurred by the company. The first advantage of equity capital is that it does not require repayment, unlike debt. This can be a significant advantage for companies that are starting up and do not have a steady cash flow or any tangible assets to offer as collateral. Another advantage of equity capital is that it provides access to expertise, as investors may be able to offer their skills or networks to help the company grow. Finally, equity capital allows for greater flexibility, as there is no fixed repayment schedule or interest rate to worry about. One of the biggest disadvantages of equity capital is the dilution of ownership. As new shares are issued to raise funds, the ownership stake of existing shareholders is reduced. This can limit the control and decision-making power of the founders and other key stakeholders in the company. Another disadvantage of equity capital is that it can be more costly in the long run, as shareholders often demand higher returns than lenders. Debt capital. Debt capital, on the other hand, refers to the amount of money that a company borrows from banks or other financial institutions. Unlike equity, debt has a fixed repayment schedule and interest rate that must be paid back regardless of the company's performance. If a company is unable to meet its repayment obligations, it may face bankruptcy or liquidation. The first advantage of debt capital is that it can be cheaper than equity, as lenders typically charge lower rates of interest than shareholders. This can be especially beneficial for companies with a strong credit history or valuable assets to offer as collateral. Another advantage of debt capital is that it does not result in dilution of ownership, as lenders do not hold any stake in the company. Finally, debt capital can provide a tax advantage, as interest payments on loans are tax deductible. One of the biggest disadvantages of debt capital is the risk of default. If a company is unable to make its repayment obligations, it may face bankruptcy or liquidation. Another disadvantage of debt capital is that it can be inflexible, as lenders may impose strict covenants or conditions on the loan agreement. Finally, debt capital can lead to a high level of leverage, which can be risky in times of economic uncertainty or market volatility. In conclusion, both equity and debt capital offer advantages and disadvantages for companies looking to raise funds. While equity capital can be more flexible and provide access to expertise, debt capital can be cheaper and offer tax advantages. Ultimately, the choice between the two will depend on a company's financial situation, growth plans, and risk appetite. I hope this video has helped shed some light on the differences between equity and debt capital structures. Thank you for watching.